All right, MACD. Okay, so the first thing I want to talk about with the MACD is a basic rundown of the MACD. Okay, of really diving in and explaining on how it works, because what I've found is that most people don't really understand how it works. Now, is it critical to understand how it works in order to trade it? No, it's not. But it is helpful to understand the why behind why things work. So that's why I'm going to teach it. It's helpful. It's not critical, but helpful. And I'm not going to bore you with too much information. I'm just going to give you what's critical. So the first thing is, what does the MACD stand for? Pop quiz. What does the MACD stand for? Does anybody know it all? Wrong screen. There we go. Anyone know what the MACD stands for? Okay. All right. So the MACD is the moving average divergence convergence. Okay. Now, if you're anything like me, when you hear that name, you're like, okay, that doesn't really mean anything to me. Like, what does that mean? What's moving average convergence divergence mean? Right? No clue. So here, let's break it down. Each part of the equation there. Good job, Gary. Good job. Moving average is the average number of candles averaged together. So a 50 simple moving average is the price of 50 previous candle, and that's the closing price of 50 previous candles divided by 50. Okay, very simple. Very, 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 very simple. You change the number, 25, 20, whatever period of moving average you want to use, that's how it works. Okay. Now, an exponential moving average is the same thing, except that it is weighted to give the most recent candles more significance. So again, that's probably something a lot of traders didn't realize, that the exponential gives more power to the most recent price, whereas simple is a straight up average. So I kind of like the exponential because it gives a little bit of priority to what's been happening recently. And recently is more important than what was happening 50 days ago, right? So I like exponential moving average. That's my main reason. Now, here's an example on the chart. We've got some moving averages here. There is a 200 period right here. And then this one is a 10. And this one is a 20. Okay, so these are all moving averages on the chart, right? Just to give you an idea of what they are. Now, we are going to be talking about the MACD. You can see the MACD below here, but for right now, I'm just explaining what moving averages are. All right, convergence. Okay, now this is pretty interesting. Convergence, well, Kevin just asked a question. Kevin, I don't actually know how the weighting formula works. I could look it up and let you know, or you could probably look it up and figure it out. I'm sure it's publicly available, but I don't know how they give the weighting preference to the most recent data, the most recent closing prices. I do not know how they do that. Okay. So anyways, we talked about moving average. Now we're going to move on to the next part, which is convergence. Convergence happens when the price of an asset and a moving average and an indicator move towards each other. Okay, it happens when the price of an asset and indicator move towards each other. So let me give you an example. Okay, so in this particular scenario, we can see that the price here, that's where I'm circling. See this? That's price, and it's moving up. Okay, now you'll notice that the MACD is moving in the same direction. So they're moving in the same direction. Price and the indicator are moving in the same direction. Okay, very important to understand that's what convergence is. So MACD, first part is moving average. The second part is convergence, and convergence means when the price and the indicator, so you can see price here is moving up and the indicator moving up, is in the same direction. Okay, that's how that works. Okay, so let's keep moving. So now we're going to take a look at divergence. Divergence. Divergence is when the value of an asset, indicator, or index move, the related asset index or index moves in the opposite direction of the indicator. Okay, and I wrote this a couple months ago. It's nice to go back and look at your work. I wrote this a couple months ago, and I don't really like the definition I wrote. I would redo this now. So let's work together and redo my definition because I don't like what I wrote here. Basically, it means when price moves in the opposite direction of the indicator. That's how I would redefine this. Okay, I was trying to get too complicated, but when price is moving in the opposite direction of the indicator, that is when divergence happens. Okay, so let's go ahead and take a look at that on the chart. All right, so, and they're moving in the opposite direction. Okay, so here's a great example. Okay, and it's cut off a little bit, but right here, this image, you see we have a new low here. Okay, and yet now we have a new low here, but the MACD does not have a new low. So we have a new low in price, okay, a new low in price, but not having a new low in the MACD. So in other words, price is moving down, but the MACD is moving up. So you can see that price is moving down like this, and the MACD is moving up like this, right? Now, so my indicator here drew this line, which is an indication of divergence taking place. So it just automatically drew this line so that we would know where divergence was taking place. But you can see it with your eye that price is moving lower, but the MACD is not moving lower. So that's what divergence means, okay? So the whole thing in review, MACD is moving average divergence convergence. All right, so that's a pretty good understanding of the name and what all of the different components of this tool are. Now, I'm going to go ahead now and get into some more details on this MACD because there's a lot of different moving parts here that you should understand as well. So the parts of the MACD, we have the MACD line right here. We have the signal line and the histogram. So let me show you where all of those are. Okay, so the first part is the histogram, which you're going to see is right here. That's the histogram. Okay, very straightforward. And I just zoomed up on the MACD. This is an image of the MACD. The chart itself is not in this image. This is literally just a zoomed up image of the MACD. So the first part is the histogram. Okay, the next part is the signal line, which you'll see right there. I pointed an arrow to it. And then the next part is the MACD line. So in this specific example, the signal line is the orange line and the MACD line is the blue line. And I'm going to explain what each of these lines is as well. Okay. And so you're not going to, just saying, you're not going to get this kind of training anywhere else. I built this because I couldn't find it anywhere. Okay, so the baseline is also known as the zero line, and that's anytime that the indicator is above zero or anytime that it's below zero or if it's right at zero. So that's when it's negative, it's below zero. When it's above, it's above zero. So that's the baseline. All right. So Now, how does the MACD work? How does it actually work? Well, there are 3 exponential moving averages in the indicator. There are 3 exponential moving averages in the indicator. All right, and so which ones are they? There's the 26 period EMA, the 12 period EMA, and the 9 period EMA. 3 different, the 9, 12, and 26. Okay. And so here's how the calculations actually work. The histogram is calculated by subtracting the 12 minus the 26 period EMA. Okay, so basically it is the difference between the 12 and the 26. And so they draw that in. They draw that in on the chart representing a histogram. So if the 12 EMA is 10 and the 26 EMA is 20, they subtract it and it would be 10, and then it would be shown as 10 on the chart, right? And so that's how the histogram works. And again, if the number is negative and goes below the 0 line, it'll be red. And if the number is positive and goes above the 0 line, then the number is green. So that is really simple. And I bet a lot of you probably didn't know that the histogram is literally just moving averages. Okay, so let me pull up a chart here and just show you what it is, right? So here's a chart, and I'm going to pull up a different one here. Or I'm just going to add a moving average. Insert, indicator, moving average. We're just going to move. This is just going to be an example. So we're going to add the 26. Okay. And then this one is going to be, we're going to edit this indicator here. If I can, here we go. This is going to be the 12. Okay. And so now you'll notice, let's look at the chart here. We got the MACD. All right. The MACD and the indicator. Now look, it's the difference between these two indicators. That's all it is. So this gap right here, you see this gap in between these two moving averages? That's all the histogram is. It's just the gap in between. And so you'll notice as the price, this is a really steep move. As the price gets steeper, the gap gets wider and the MACD gets more negative. Okay, so the MACD. So that's how it's demonstrated on the chart. It's just the gap. It's the difference between these two moving averages. So again, that's pretty interesting. So really, you don't even need to MACD. All you got to understand is to identify these gaps, right? If you become really familiar with trading, you can see the gap on the chart. You don't necessarily need the MACD. When you understand how things work, you could then maybe eliminate things from your chart, right? Because you're just so familiar with how price moves, how moving averages work, how the MACD works. You necessarily don't need that on your chart. Another thing, like for example, just to talk about that with the fibs, you know, a lot of times I don't even need to draw fibs. Actually, I don't really draw fibs because I can just eyeball it, right? I can see, oh, well, this looks like a 50% retracement because my eyes have been seeing fibs so often. I don't really need to use them anymore, right? Because my brain, see, that's where brains come in. Brain, you know, they say with the 10,000 hours behind the chart, you kind of get the hang of this stuff. After you looked at these charts for 10,000 hours, your brain kind of knows what it's doing. All right. So anyways, that's how the histogram works. Now let's keep moving right along here and go through some more training. All right. So there's more. There's more. And so you can see here, here's the histogram right there, signal line, MACD line, baseline or 0 line. Okay, so now we're going to talk about the MACD line. The MACD line is the blue line below the chart on the MACD indicator, and it is calculated by subtracting the 12-day EMA minus the 26 EMA. Okay, so again, this is really the exact same thing, guys, And I use the day here. It doesn't matter. It doesn't have to be day. It's just the 12 and the 26. This MACD line is the exact same thing as the histogram. Exact same thing. Okay. So not all MACD indicators are created equal, and not all of them do. That's just a note I forgot to put in here as far as a note. Not all MACDs have a MACD line. You might notice that some MACD indicators have only one line, but most of the MACD indicators have two lines. And this one's the MACD line, which is literally the exact same thing as the histogram. So we can even see it, right? Look, here it is. There's the gap, and here's the MACD line right there, the blue line. So you'll see it's literally the same thing, just shown in a different way on the chart. It's duplicate data. It's duplicate data. So it does serve a purpose, and I'm going to go over that in a minute, all right, if you have two on your chart. All right, now the signal line is simply the 9-period EMA, right? And they call this the signal line because it gives a signal when price crosses over the MACD line. The crossover can be an indication that the price is about to change directions. Okay, so again, this is a 12 and 26 EMA up here, a 12 and 26. The histogram is literally the gap, and then the MACD line, which is the blue, is the same gap. It's the 12 minus the 26. But then the other line, it's hard to see because I have my colors, but right here, this orange line is just a 9 EMA. It's just a 9 EMA. That's all it is. Okay, so I don't have a 9 on the chart up here, but if you had these three moving averages, you could basically get the same data. If you had a 9, 12, 26, you get all the same data, all of the same data that you get on a MACD with those three moving averages. Okay, all of it. Now, it's different because it's visualized differently, though, right? It's visualized differently, and so the MACD helps as a visual aid. It's a visual aid to help you understand how to trade some of these things. Okay, now, so there we go. So now I want to just talk about the signal line and how it works. So that's actually the end of my presentation there. And so there's some different strategies that we can talk about. There's the convergence strategy, the divergence, the zero line, and the signal line. So I'm going to actually go over all of those, okay? I'm going to go over all of these different ways to trade off the MACD, right? So let's go ahead, and there's 4 different ways, and I'm going to go over all of them here. Discard those scribbly lines, yes. Okay, so now let's go back and get the chart up. Wrong chart. Let's get the chart. I got too much stuff. Too much stuff on my screens. Okay, sorry about that. When you got 6 monitors, things get a little crazy. All right, so the first one we're going to go over is a convergence strategy. The convergence strategy. And if anybody remembers what convergence means the price and the indicator are moving in the same direction. So one way to trade this is just to use price action and to trade it in the direction of the indicator. Okay, and one really good way to do this is when you're trading within the direction of the trend. And I have been teaching this a lot over and over and over again. And basically every webinar that I teach, I always prefer to trade in the direction of the trend. I mean, this was a downtrend on the euro, and I love taking trades like this because it's such a good move, right? Some of these short moves weren't great. I mean, this one was pretty good, but some of them happen really fast and they're really big, and usually in the direction of the trend is where those happen. Okay, so when you're trading in the direction of the trend, basically this is a bonus. This has nothing to do with the MACD. But what I like to look for is a weekly trend to the upside, and a monthly trend to the upside. And I will just follow those charts. So let's go to the monthly. You see the monthly's down. I want to take shorts. Weekly is down. I want to take short trades. Okay. And so if I see that, it's time frame continuation, time frame power. We got this big, huge down move. Look at all these weeks in a row. It's much. If we look at this big period, I'm going to ask you guys a question, and trust me, I'm going to get to the MACD, but just look at this big move. During this period of time, which is over a year since May of last year, which would be beneficial for your trading? Taking long positions or shorts overall? Which would be better for your trading over the last 13 months? Which direction would be better for your trading? What do you think? Go ahead. Let me know in the comments, guys. What do you think? Juiced is right. Kevin is right. Win is right. Yes. Angel is right. Yeah, it's obvious. Raju, short. Yes. Thank you. Thank you for your participation. Appreciate it. Yeah. Yep, Gary. Right. Everything. And I know Gary's typo. It's okay, Gary. I make them too. You're not owning it. You're saying down. But yeah. Hey, it's down, right? So in this particular situation, I pretty much only take shorts on this. Now, let's go ahead and pull that MACD back up. And if we do this, you'll notice the convergence strategy basically means when price is moving down, you're going to take a short, and the MACD is moving down. When they're moving in the same direction. When price and the MACD are moving in the same direction, you just take a trade in that direction. Okay. That's a simple strategy. Very, very simple. Okay. And anytime that you're in the red and the price is moving down, you just short. That's where the convergence trading strategy is. All right. So now if we go back to it, back to the, so the other versions here, the other one was a divergent strategy. Now, a divergent strategy is a counter trend strategy unless you turn it into a trend strategy. So divergence means that, like we talked about earlier, it means when you make a new low. So right now we have divergence. See, there's a low here and a low on the MACD. Okay, and I'm going to get rid of this other indicator so I'm not distracting you. But look, we got a new low on a low here, right? Right here. A low here. And you notice that the MACD doesn't make a new low. Okay, so this is called divergence. And so one of the strategies you can trade here is when you see divergence, see the price of the MACD is moving up where the price is moving down. One way to trade divergence is to buy on a candlestick pattern when you see divergence, okay? To buy when you see like this is an inside candle and a break, you would buy on this trade. Stop loss right here. This is a good trade. Do not get me wrong. This is a good trade, and you can do that. I mean, this is a 353 pip counter trend trade. Solid trade. There's nothing wrong with that. Now, me personally, I do like to just be patient and wait for the trades in the direction of the trend. That's just me. So what I would do is to try to find a divergence scenario in the direction of the trend. So I'll highlight this and I'll look for divergence on a lower time frame, and let's see if we can find it. So I highlighted that. So let's go now and see if we can find the highlighted area. Okay. All right. So we found the highlighted area. And now, is it possible to find divergence on a short trend? Okay. So now you'll notice we have divergence here, a higher high. It went, here's the high, a new high. See this? See how this works? Look, we have a high here and a new high. But then now look at the MACD. The MACD is getting lower. Another new high, and the MACD is getting lower. And my indicator drew the line. So now I have a divergence strategy, but now I am going to take the trade in the direction of the trend. So this is a reversal. A divergent setup is a reversal. But you can take a reversal in the direction of the trend or counter trend. So I gave you two examples here. This one, I would take short trades in the direction of the trend instead of long trades counter trend. And that's either way will work, but just test it out. For me, this is a personal preference. I just know that I don't need to do the other one because I'm looking for the very best of the possible setups. And for me, that one is the one that really works. So that first setup we talked about was the convergence strategy. The second was divergence, and I gave you two divergences. One is just a straight up reversal, and the other is a reversal in the direction of the trend. Does that make sense to everyone? I want to make sure that that makes sense before I move on. Does that make sense, or do you have any questions? Gary says yes. Wynn says yes. Okay, thank you. All right. I was waiting patiently for your answers, and I really appreciate it. Okay, so the next one we want to talk about is a real simple one, which is the zero line cross. And again, I like to do this in the direction of the trend, right? It makes it really easy. So we know that anytime it's in green, it's a positive. Anytime it's in red, it's negative. And then the line in the middle here is the zero line. So basically the strategy says anytime it crosses above, you buy. Anytime it crosses below, you sell, right? And so if we back test this, you can see here would be a buy right here. It might work, right? I mean, this gives you, this is about 50 pips, right? But then if you look at the other side, the down one, oh, wait, it crossed on the zero here. Here was the zero cross. Well, the zero cross was a little better because that was like 300 pips, right? And you see this was just a sideways market working sideways. And then when it collapsed, right? And so that is the zero right there. Hold on. Let's see here. Good question. So are the MA in the chart the same as the ones in the MACD? Not on this chart. The ones I was showing earlier were, Kevin. I changed it a little bit just because I don't usually change the 12 and the 20. But I can do that here just for demonstrative purposes. Insert indicators, trend, moving average. We're going to go with the 26 exponential. And then this green one would be the 12. So now it is the same. I just changed it right there. Okay. But anyways, the zero line, when it crosses over, you simply buy on the cross to the green or sell on the cross to the red. And again, I only like to do this in the direction of the trend, right? And I always use support and resistance levels as a guide as well, because I want to always find the best trade. If I can filter out and get only the best trade, then that's perfect. Okay. So in this situation, anytime you cross, that's the zero line cross strategy. Now, the very last, so I've actually taught you everything about the MACD and 4 trading strategies all in one, plus some bonus tips. And I've only been teaching for 30 minutes, so I've jammed a lot in there, but I feel like I've taught it really concisely and well, so that, not well, I'm not the greatest teacher in the world, but in such a way that you guys can understand it. Now, I'll teach the last, well, actually, before I do that, Raju has a request. He wants to know if I can put an arrow. And so you can put an arrow here, right? Let's put an arrow. So right here, you can see price crosses to the upside. So we'll just go right here. There it is. See if I can make that arrow a little bit bigger. Arrow properties. I don't know how to make the arrow bigger. Can I make the arrow bigger? A little bit. Okay, so here's where it would be. Right there is the entry. See, you just line it up. That's all you do. When the MACD crosses to 0, you buy. Okay, we'll add another one. When it crosses to the downside, right here, you sell. See, there's the buy, there's the sell. Both of them would have been winning trades, but this one would have been a lot bigger. And I like big ones. I like big ones. Big moves. The program doesn't, this indicator does not use arrows. It does not. It will send you an alert, though. This indicator does send an alert. And so, yeah, that's one thing that it does do. But it will not draw arrows. We might actually do that some point. Thanks for the idea. I never even thought of it. Good idea. I'll write that down. I just got a question became a brilliant plan. Okay. Now, the last one, the last strategy is the signal line cross. Okay. And so I'm going to zoom up the chart here to get that one. So when you got a big move, let's just look at the most recent one. When you got a big move here, and I'm going to see if I can change the properties here. The colors of, where's the colors of those things? I don't know if I can change the color. I'll have to check into it, but okay. Sorry, never mind. This is the signal line, this orange line. Okay, now, when this crosses the blue line, that is the signal line strategy. So basically, right now, we would just be waiting for these two moving averages to cross. So it would be the signal line, which is a 9 EMA. And does anybody remember what the MACD line was? What was the MACD line? Anyone remember? But we're looking for the MACD line to cross the signal line. Okay. Well, the MACD line is the same thing as the histogram, right? It's all it is you subtract the 12 and the 26 EMA, and it's the difference between the two. So it's basically this line crossing over the histogram. And so you get a nice, it's not the 26, it's the 12 minus the 26 and the difference between the two, right? So if we look at you get the value for the close price of this is 1.03, and the value for this one is 1.0433. You take the difference between the two, and you get the MACD line. So the entry is plain and simple whenever this crosses. Okay, whenever that crosses, that's all you have to it. Okay, so now let's go ahead and look at some examples. Right now, you can see this example would be to buy whenever we do this. But I personally, same thing I said before, I like to do it in the direction of the trend. Right? I like to wait for a green signal line cross in the direction of the trend. So if we look at some of the ones that has happened in the past, we had a cross right here. It's kind of hard to see. Let's see if there was an actual cross. So we had a cross happen right here in the direction of the trend. We had another one happen here. And this one would have been a counter trend. You can see it went all the way up here. But what did the price actually do on the chart? The cross, see what happens? The cross here happened, and it was only like a 30 pip move, right? So if you do it in the direction of the trend, I like to do that. And so when you're doing swing trading, you can use a daily chart, a 4-hour, and even as low as a 1 hour on swing trades. Right. So just in review, the MACD is the moving average convergence divergence indicator. And it has 3 primary calculations. It's the EMA between the 12 and the 26 and the 9. And you'll get a recording of this if you're interested or if you took good notes. But that's primarily, and then there's 4 strategies you can use to trade it. You can trade the convergence strategy, the divergence strategy, the zero line strategy, and the signal line strategy. And don't ask me which one works better, because you're going to have to test it out for yourself and figure out what works. One thing I will tell you on all of these strategies, they all work better if you're in a strong trending market, or if you're in a consolidated market, you want to trade strictly reversals. Right. So these lines up here are the moving averages. These are moving averages. The blue is the 26 period EMA, and the green is the 12 period EMA, which is the same, which the gap between the two is the histogram. So you notice if you look at this gap right here. You see how small the gap is? That's why the MACD is all crunched. And so when the MACD's crunched, it's hard to really get a good setup. And sometimes the moving averages will twist and twist and twist, and then you see the MACD getting smaller and smaller and smaller. So how do I trade if a weekly chart is in a downtrend while daily and monthly chart are an upward trend? Well, that's a great question, Harakan. What I do is I wait for the weekly to begin to flip, right? So let's look at a weekly. So we had a weekly right up here 2 weeks ago. And so I was just waiting. And when this flipped and started taking that bottom out, then I was interested, right? So these 2 weeks, I'm not interested. But once it flips, I'm interested. And when this week happens, I'm not interested. But then when it flips, I'm interested. And so that's what I do. I just wait. When it's a retracement, I'm realizing price is going up. It's getting ready to flip back in the direction. Okay. So Mark, I do like Japanese candles. Yes, you could use line charts or bar charts. But I like candlesticks. They give you a lot of additional information. I have done an in-depth training on this as well. I do an in-depth training on how to read candlesticks. And that one's on my YouTube channel. If you're interested, I can show you the video here. Here, let me show you my YouTube video all about candlesticks. So if you take the training I gave you today, plus a candlestick training, pretty powerful stuff, right? You want to try to learn a lot of different things here.